It's good. Let me do it too.
Good morning.
Good morning. Good morning. Okay, I know there's going to be more people coming in, but I want to make sure that we are not here too long today. So we're going to start. For those of you guys that are just coming in, good morning, happy Monday. Oh, let me hit record really quick. I am going to be going over for my elite agents that join us here today. I'm going to be doing the Mortgage 101 training. So if you were in it, you'll probably be leaving a little bit early today. That's okay. But we are going to go over kind of some market updates, as well as something that we did last week for the team that absolutely killed us in terms of how much work we got from it, which is a good thing, and something that I kind of want you guys to try as well with your database. Okay, so let me put this up here. Okay, so last week, kind of what we did was for the new Hometown Heroes, I've been kind of delaying it only because I wanted to get closer to July, but also I wanted to make sure the team was, a little bit caught up on work that we had. We have a new guy that started on the team as well. His name is Ralph. So if you've sent us clients, he's probably reached out to you about updates for them and stuff like that. We're just trying to make sure that we be consistent with our follow-ups for your clients and our clients, and making sure that we're giving you guys the actual updates on them consistently, right? Is not just, it becomes a little bit easier when you're under contract to close, but that gap from lead to pre-approval and looking, right? We want to make sure that that is something that you guys are involved in, at least update wise, so you know every step of the way, because not every single pre-approval is cut and dry, right? Where we can just go ahead and give the pre-approval the same day. Sometimes we need extra documentation. Sometimes it's a sticky situation, and we want to make sure that that you're updated on, that we're actually following up with the clients and getting what we actually need from them. So what we did was within our CRM, which is why it's very important for you guys to have one, right, with your clients in it. If you don't, you need to write it down and make sure that that's the first thing that you kind of get, because to do this manually, it's going to be very, very difficult. So some of you guys, you have the Hometown Heroes flyers that I made. I utilized that Hometown Heroes flyer. And what I did was I sent it out to about, I think it was like 900 leads and clients all at once. Okay. Through text message, basically just put the flyer, said, good morning. It's possible that you may qualify for this. Give us a call or schedule a call. And I put the link to schedule a call. Within 10 minutes, I was already, or not within 2 minutes, we were already getting people scheduling phone calls, people calling the office. Friday, well, what was that? Thursday, my calendar was literally full in 15-minute increments for phone calls. And basically from 11 to about 7 o'clock at night was 6:45 was the last phone call. There was no gap in between. Talking about 11, 11:15, 11:30, 11:45, 12, 12:15, so on and so forth. Friday, it was pretty much the same thing. There was one hour and a half gap, which was pretty odd. Nobody booked within that hour and a half. It's like 2 to 3, 3:30. But before that, from the morning all the way to that time, and even after 3:30 till about 5, we had people that set up phone calls. The team is working on people that have set up phone calls today. We got about 6 applications over the weekend, 5 or 6 over the weekend, for people that want to get into Hometown Heroes. So I say all of this to say, you need to send this to everybody that you guys know, and start getting them, because really a lot of people like to say, that the biggest thing is that rates are higher. The biggest reason why people don't purchase is because of money and funds. And so when you tell them that they're going to be able to have these funds, right, and there's nothing else that's stopping them, they're going to be interested in taking advantage of it. And we saw that. And we're still seeing it from that one text message that we sent. So I think it's very important for you guys to do the same thing. Everybody that's on your phone, upload them to your CRM and just send same thing. Flyer. I think you would. I think you can qualify for this, even if you don't know if they can or not. Doesn't matter. It's just to start that conversation. I promise you guys will get a lot of traction from it. We did. So I kind of wanted to let you guys know that we did that, so that way you guys can do the same thing. Some of the people, if you sent us a lead, they were one of the ones that got it. I know Kendra's mom got it. I'm pretty sure some of Shamika's clients got it, and Deborah's clients, and Christine's, and Carl's, and Andres's, and so on and so forth. If you sent us a client before, they did receive that text message, so you can follow up with them, and see if they're interested in taking advantage of it. Right, so it's a good way to strum up business. So far this month, rates have been pretty consistent in terms of where they've leveled off at, right around 6.5, 6.75. Right around there is usually what we're seeing right now. The stability is good. I think that at this point now is where we're going to start to tick down little by little, and hopefully end the year in the fives. That's the goal. That's what I've been saying, mid to late 2023. We're at mid 2023. So now I believe is when it's really going to start going down. We saw that the Fed stopped raising hikes, which is a really good thing for us, not because Fed rate hikes correlate with mortgage rates, but now that volatility of the continued rate hikes have stopped. And now the market should be able to kind of level out as well. We know that inflation is also kind of coming down. So we are in the perfect position for rates to come down here at the end of this year. And that's really going to be where, people are going to be trying to utilize Hometown Heroes and the lower rates, because that 5 number, right? That's what people get stuck on. All right, so really quick, existing home sales rose 0.2% from April to May, and they're down 20% year over year. Inventory continues to decrease as well. We're negative 6.1% year over year on inventory. So that existing home sales are basically homes that are already existing, right? Owners that are selling their homes to buyers. It's not new construction homes. For them to increase month over month is good. The negative 20% year over year is not a surprise because of the lesser inventory that we have as well. And then on top of that, May was kind of like the last month last year. Remember, we always say it, May was kind of like the last month last year before the market kind of started going in a downward trajectory. It was from like January to May was decent. And then from there, once the Fed stopped buying mortgage bonds and started raising rates, is where we saw the market decline. Inventory is finally being built. Finally, National Association of Home Builders did their housing market index for June, and it showed that builder confidence rose to 55. Remember that their scale is 0 to 100. Anything above 50 signals building, anything below 50 signals contraction. And we saw that happen. We saw expansion happen with housing starts rising 21.7% from April to May. So last month's reading, we did go over it around the same time, but if you forgot, it was the first time we were over 50 in about a year, where we went to, I think the reading was 52. And you saw that as soon as they hit over 50, they start building. And building or housing starts rose 21.7%, which is huge. What's interesting to me in the report, and I didn't put it in my notes, but is buyer traffic is still in the 30s. So it seems like they're building because they're getting ready for that influx of builders or buyers that are going to be coming in now as the market kind of settles down. And this is good because this is really how inventory is built, right? I told you guys, inventory is not from owners that sell their property, because what's going to happen, they're going to move into a new property, right? So it's kind of a wash. It's usually made from builders. So the more inventory we get, the better. And then lastly, initial jobless claims were at 264,000, and continuing claims are still pretty consistent at 1.75 million. I'm surprised I haven't seen that, even if it's a slight uptick in continuing claims, we haven't seen it yet. But the stability is there, and initial jobless claims are continuing to increase as well. Remember, initial jobless claims are people who filed for unemployment for the first time, and continuing claims are people that are still on it. This is important because it's usually the early indicator for a recession, which we've heard news that people the experts are starting to think that it's going to be a real possibility that we end up in one by the end of this year. I believe that we're kind of already in one, but you typically don't know you're in a recession until 6 months out, because a technical term for the recession is basically two negative quarterly prints of GDP. The last one that we had was positive. So we have a negative reading and then a second negative reading. That's what really considers a recession. But by that time, you're already 6 months in it. Okay, I'm going to be sharing my screen now. Well, before I do that, I don't know if anybody has any questions on the news, on what we did for the Hometown Hero stuff or anything like that before I go over the Mortgage 101 presentation.
I wanted to know, what exactly did you send out in the text? Was it just to let them know it was available? Was it certain verbiage? Did you have some kind of flyer created? Like, what did you send out?
Yeah. So I did have a flyer. Let me see if I can find one of the text messages here. I did have a flyer that was created, and it was really very, very simple. Let me see here. See if I can find it. I think this guy got one. Yeah. Oh, hold on, because I don't want to give this info away. This stuff. What I'll do is I'll screenshot it. That's what I'll do. Boom. Okay, let me get out of there. So this was literally the text message here. Make sure it's the right screen, screen one. Yeah. That's literally it. And the reason why I wanted to make it so simple is because you want people to start actually engaging into it, right? And so I basically just put, good morning, just wanted to let you know you may qualify, give us a call or schedule ahead of time. And I put the calendar link there. And it's just basically the simple flyer up to 35,000. Some of you guys already have this with me on there. And I'll show you as well. This is kind of, I sent this at 9 in the morning on Thursday. And this is kind of what my calendar looked like. The next, pretty much like that. And today it's pretty much the same thing. This whole week we have actual consultations for people that filled out applications. And we've got a few phone calls today as well. So very, very simple. You don't have to be too crazy. Send them the flyer, send them a flyer if you already have one created. And just basically say, hey, this is probably something that you could use. And we did get calls from people that had already closed with us, because I just basically sent it to a client list. And that's okay, because that conversation is, hey, I sent this, this was a mass text to all my clients. You won't qualify because you already purchased. You're not a first-time home buyer. However, you probably know somebody that does, because this program is very, very simple. There's really not much to it, right? You just got to be a first-time home buyer, buying a principal residence, in being full-time and being a full-time employee. That's it. So if you know somebody, you already know the experience that I gave you, just give them my information and give them a call. And so that's what we did for the people that called that they already, or they didn't qualify, or that they already had a property or whatever the case is. So whatever reason they didn't qualify for, we just kind of switched it over to basically having them refer us friends or family. Any other questions on that, or any of the news we went over? No problem, Shamika. Okay, so this is Mortgages 101. It is a very simple presentation on the kind of loan programs that are out there, the bullet points for them, and as well as contract to close. What we're really going to get into that's a little bit more high level for you guys, that I actually enjoyed showing this the last time, is appraisals and appraisal disputes, and kind of how that looks like. So we're going to look at a sample appraisal and go over it and kind of see what the listing agent thought or saw. In my opinion, she was inexperienced, but that's kind of what happens. And so it was a good kind of teaching moment for her. So yeah, we're going to go it. A lot of it is really is pretty basic, but we do get into some high level stuff. If you guys do have any questions as I'm going through it, you can unmute, raise your hand, whatever the case is. Okay. So what we'll be covering are the standard programs, right? FHA conventional VA bank statement program, and DSCR, which is considered debt service coverage ratio. Okay, that's what that stands for. When you hear people say the Investor Solution Program, they're talking about DSCR, okay? Pretty much. Also, the process, right? Contract to close, what that actually looks like from the loan officer side or the financing side from beginning to end. Appraisal, condos, employment change, rescores, and sourcing funds and stuff like that that we kind of see on pretty much almost on every transaction. Well, sourcing funds specifically, but we're going to kind of go over that as well. So FHA, I didn't write this on here, but I do want to let you guys know, you do not have to be a first-time home buyer to have an FHA loan. It's the biggest misconception, okay? What qualifies you to have an FHA loan is if you don't currently have one. So if you have a house, primary home, and it's conventional, you can move from conventional and purchase an FHA loan, okay? And buy a new primary that way if you wanted to. If your credit wasn't there, whatever the case is, you can, technically speaking, get a home FHA. It's a little bit difficult once you own a property, but it is possible, okay? Oh, someone's unmuted here. Hey, if you're unmuted, can you mute, please?
Can I ask real quick? So does that apply with VA as well, or is FHA and VA like the same?
Yeah, so no, VA as well. You can get, so if you're a veteran, believe it or not, even if you don't have any eligibility, there's still a way for you to purchase using VA. Okay, something else that a lot of people don't know. So if you have a VA loan and your eligibility, typically the standard eligibility is 36,000, right? That's what that number is. But there's a formula that the banks use depending on if there's any eligibility and how much is left, would determine how much that borrower would actually qualify for at 0% down. Okay, so even if they do have a VA loan and let's say they are looking to purchase at 400,000, but their eligibility only allows them to purchase at 200. That's really where the issue comes in, but it doesn't mean that just because you have one VA home that you can't qualify for another one. It's not the case. Okay, so FHA 3.5% down, minimum 580 credit. 100% of the funds can come from a gift, and we do need a bank statement from the donor. Okay, very, very important that the client knows this up front because a lot of people are very private, and the gift donor may not want somebody else to see their bank statement. I get it, but it's just a requirement from FHA. There's really no way that we can get around that, and it's also just because they want to make sure that client, FHA, being a government loan, didn't just get it cash, give it to the donor, and then the donor deposited it, and now is going to give it back over to them. All right. Mortgage insurance is for the life of the loan, unless you're putting 10% down, and the team will get that. Unless you're putting 10% down, then mortgage insurance goes away after 10 years. So it doesn't matter if you end up being at 80% equity in 3 years, 4 years, 5 years. You got to wait the full 10 years. It's fine. That goes to everybody. Don't worry, I'm not ignoring phone calls. It won't go away until 10 years, okay? Rare condo approvals, single unit approvals are very, very difficult to do on this, but has been done with us. The biggest thing is just getting the client understanding that it's a big commitment and it's a big investment for them, because when you go under contract, you automatically have to do your inspection, right? That's your inspection period. But now also you got to get the full condo docs, everything, so that we can send it over to FHA so that FHA can review it and tell us whether or not they're going to approve that condo or not. And so what happens is you can be 2 weeks into the process and the buyer's fine, but because we have to go through the FHA single unit approval process with sending them the documents and stuff like that, then they may be 2 weeks in and we find out that we can't do it for whatever reason. And so a big reason why FHA condos actually get declined is usually in the condos, in the bylaws or the CC&Rs, the covenants and restrictions, because FHA, remember, it's a government loan. Associations, they have no boundaries. And so they'll basically say, or they'll have the client fill out an application, and they're basically saying, we're going to check credit, income, and assets on your application. They're not financing. They're not a financing company. So FHA is going to be like, this is discriminatory, which technically is because you're not actually a financing authority. And that's usually where the biggest declines come from, believe it or not. It's usually not the budget or anything else. Is once we get those documents and it basically says that we are going to, like, we have the right to say no to anybody, that's considered discriminatory and FHA won't approve it. So that's why it's really, really tough to get those condo approvals. There is renovation programs available, FHA 203K. You can utilize it. Lenient student loan guidelines, as long as they don't have a $0 payment, and that includes with an income-driven repayment plan as well. So back before, I think it was like 2020, 2021 is when they passed the law, when FHA passed the new guideline, basically stating that you can use an income-driven repayment plan, or they actually lowered the amount of that you would actually hit for a client. So before it was 1% no matter what, even if they had a payment plan. Then it went down to 0.5% with the option of a payment plan. Yeah, Deborah, you got a question?
Yes, good morning.
morning.
Okay, you're talking about me. I actually have a payment plan, but it's $0 every month. So I remember in the past, I actually got denied through NACA because they stated that I had to have 6 months payments. And I told them I wasn't in default or anything. You know, I'm in good standings with a $0 payment every month. But they still told me I couldn't qualify unless I made payments.
Yeah. So, I mean, NACA has their own kind of guidelines because they literally do everything themselves, the financing and everything. So that 6-month rule is most likely because it's them and it could be their overlay. However, when it comes to FHA, I don't know why they don't allow the $0 payment thing, but it's really very, very clear in their guidelines. It basically says, you know, payment plan greater than $0 can be used or something like that. Conventional doesn't have that. If it's a $0 payment plan, it can be used. So if we know that somebody's going FHA, we basically just say, hey, beg them to tell you $10, $15, $20, whatever it is, so we could utilize that. And that's usually once that client starts having that conversation with them. And honestly, right now, because student loans are going to start up in August, we're doing it. I suggest you guys do it as well. Every single client that you talk to that has student loans, get into an income-driven repayment plan. This will hurt your qualification if you do not, because they're automatically not going to get put into an income-driven repayment plan because they haven't actually reapplied for it within the past 12 months. Remember, it goes away after 12 months. Right now, it's deferment forbearance, but once it starts up in August, people are going to be hit hard with student loan payments. So they need to start getting into income-driven repayment plans now, so that way they're protected.
Okay, thank you so much.
No problem. Appraisals now stick for 6 months. Used to be 4. Remember when I know you guys know about the 4-month rule. I don't know if you guys know that it increased to 6 months. We talked about it Monday Mortgage Minute a while back, because I think this has already been since like September of last year or something like that, where now the appraisal will stick on the property for 6 months. It's not terrible. What I tell listing agents all the time is, hey, if you were to take a conventional loan and that appraisal doesn't come in where you want it, what are you going to do? You're going to take another conventional loan, right? It's the same thing. If you take an FHA loan and the appraisal doesn't come in where you want it, what are you going to do? You're going to take a conventional loan. It's the same thing. It's just a different way of getting there. And the FHA, you're giving, you know, somebody the actual chance to be able to become a homeowner. Conventional, minimum 3% down payment. This one is only for first-time homebuyers. So FHA, you can do 3.5% no matter what. Dr. Carla, why with the volatility of the market? That's a good question. I wish I could ask HUD. I'm not sure why they raised it to 6 months. I think it's probably, I mean, yeah, nationwide, there is a lot of volatility. That's honestly a good question. I didn't think about that. But I'm not sure why they increased it to 6 months. But yeah, you're right. If like you got somebody in Phoenix with an FHA appraisal, and Phoenix has been going down for some time, right? Now you have an appraisal at 350 and the property's only worth 315 now. That's actually going to hurt somebody. You're right. Conventional 3% minimum down payment. That's only for first-time home buyers. If you're not a first-time home buyer, minimum is 5%, but you don't need 20. Okay. Credit score minimum is 620. Guys, just because it says 620 does not mean that the application is going to run 620. Okay. FHA is more black and white. Conventional is very, 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 very picky on their credit score and DU runs. Okay, if you're 620 and you're coming in with 5% down, that application is not going to run. Yes, you can. Yeah, I'll get it to you, Karen. That application is not going to run, no matter which way you put it, unless you have a COBAR with a 700 credit score. That 620 with 5% down is very, very difficult to get the DU approval unless their DTIs are like 15, right? So that credit score minimum 620 usually runs more so on refinances and not even usually cash out, usually rate and term. Somebody that's trying to lower their payment and stuff like that, and they have a good LTV, 40%, 50% is when you're going to see that actual DU run happen. That's why a lot of these down payment assistance programs, they say no credit score required. You can do it with a 620, this and that. And what they don't tell you is that this thing has to be Fannie Mae DU approve eligible or Freddie Mac LP approve eligible or accept. And most of the times they're not. Okay. 100% of the funds can come from the gift, and we do not need a bank statement for the donor. Okay, this is the good one. This is the good thing with the conventional. Monthly mortgage insurance can be removed or paid at closing. So that client has a $150 a month mortgage insurance payment and they don't want it because they're already over whatever their budget is. They will have the option to pay it off at closing. It's usually doesn't make sense financially for them to do it, because when you figure out how much it's going to cost as opposed to how much those monthly payments are, usually it's about 4 or 5 years before you actually catch up with the amount of money that you're paying at closing. So usually doesn't make sense, but that option is there in case we have a DTI issue or in case the client's just adamant about paying it down up front. 10% down option for condos if reserves are bad. This is with a second mortgage, okay? So if the reserves are not good for the condo, Fannie Mae says you have to be at 75% loan to value, okay? That's your actual loan to value, your Fannie Mae conventional loan. But you can get a second mortgage to cover and get all the way up to 89.99%, which will put you at that 10% down option for condos. It's that second mortgage. What we do a lot of times right now for clients is we're doing that option, which is a HELOC basically. The only thing is, what I tell people is, especially this has hurt a lot of people since 2020, 2021, because the people that got into condos with the HELOC back then, those HELOCs are adjustable. Those mortgage payments adjust every single month, depending on the US prime rate and the margin for the bank. And so when they started off with a $250 payment, they may be at $500, $550 sometimes on the month, depending on the mood of the market, which is insane. So try to tell people, hey, this isn't the second one's adjustable. You're going to be at this $500 a month payment for right now, but prime rate increases, whatever the case is, your payment's going to increase. From here on, right now, moving forward, I don't see the prime rate increasing, especially with the Fed stopping the rate hikes. So I think in my opinion, when we're doing these now, we're looking at worst case scenario. But those people that bought in 2020, 2021, they do have that adjustable, and it's really, really hurting them. Renovation program is also available, conventional home style. Lenient student loan guidelines, you can be a $0 payment on this, and appraisals don't stick, and they can be transferred over. The reason why you don't see people, or the reason why you don't see lenders transferred over is because they may just not want to. Conventional doesn't require it. FHA does require it. So typically, if you have a client that went with Chase or a major bank, or the loan officer just being an asshole, they won't transfer the appraisal, but it can be transferred, and any bank will accept it as long as it's an actual appraisal that was done within that, either if they have an AMC, an appraisal management company, or they have their own people, whatever the case is. So VA, okay, it's 0% down. Their interest rates are typically a little bit lower. There is no mortgage insurance. Okay, they do have what's called a funding fee, which is basically it's about 2.15% right now. That gets added back into the loan, but there actually is no their monthly mortgage insurance payment. So VAs actually, or veterans usually qualify for a little bit more, even with the same income, because they don't have that extra $150, $200 a month payment. 580 credit score, closing costs still need to be paid by the bar. Okay, so, and this is something too with clients, and we try to tell them all the time, especially with Hometown Heroes. Hey, you're a veteran, you don't have to come in with pretty much anything. Hometown Heroes will cover your closing costs. Okay, great. Hey, you still have your EMD to the seller. That's still your requirement as a buyer, right? It's $1,000, $2,000, $5,000, whatever it is. Don't be shocked when your realtor tells you, hey, this is your EMD, you need to put it into title. Are there ways to get it back? Yes, we can get creative to get that back after, once we get the clear to close and stuff like that, or once we get the loan approval. But realistically speaking, you need to show the seller that you're serious and you need to put money on the line. So that's a conversation to have with borrowers. I've been seeing it lately. I don't know why people are thinking that they literally need $0, not understanding that they have an obligation to the seller. VA certified appraisers only. So the appraisers, they actually have to be approved with VA and things like that. Only program where you can get cash back at closing. So if you're getting a gift, if you're getting closing cost help from the seller, whatever, you actually can get that back. Co-signers can only be spouses. There are very few exceptions to this, okay? Very, very few. If you ask or if they ask, only spouses. Because the only time that it's not going to be like that is if the veteran is maybe disabled and they're being taken care, their daughter or son takes care of them, and they're actually like their dependents and stuff like that. That's where the VA will allow that. Other than that, co-signers can only be spouses. Property taxes exemption for disability vets. So if you guys don't know this, if a client is, or if a veteran is 100% disabled, when we're doing our property tax estimates, we put $1 on those property taxes. So now they don't have mortgage insurance and now they don't pay property taxes. The only things that they're really being hit for on their mortgage is their principal and interest and their homeowner's insurance. That's it. So we qualify them based off of the dollar tax return, because if they're 100% disabled, they are exempt from property taxes. Bank statement program / 1099 program, pretty much the same thing. Depends on if that person is really, really self-employed with some biz or if they are Schedule C, right? You have to at least have 2 years in the business. You don't need to show 2 years. You can do 12 months bank statements, 1 year 1099, but you have to have 2-year history. You can do this for a primary residence, second home, and investment. Credit score as low as 620. I'm telling you right now, your pricing is going to be terrible in terms of your interest rate. Your down payment is going to be much higher, 20-25%. And it's just not going to be an overall good look for you. There is no down payment assistance programs. Now we're getting into these, what we call non-conforming loans. There's no down payment assistance programs for these. So they have to have the money. Sometimes they have to have reserves. These are for people that have everything, including assets and credit and income. They just don't file it with the IRS. That's pretty much it. Okay. There's no tax returns needed. I don't want them. If I were to put them in the file and the bank sees that, they'll literally deny the loan because I have tax returns in there. So very important on these programs. I don't need them. 10% down payment. Gift funds are welcome, but borrower does have a minimum contribution. Typically it's 5% if they're doing the 10% down option. But that minimum 10% down depends on your credit score. You need to be 720, 740 in order to be able to utilize that 10% down payment. Right? You can't be 620 and putting 10% down. Cash out refinance up to 85%. Recent foreclosure, bankruptcy, short sales, all okay. I believe the turnaround is like 24 to 48, 24 months, I think, is the soonest. And even for foreclosures, which is crazy. And then 30-year fixed loans. They do have the option of ARMs, but typically these are 30-year fixed. DSCR, debt service coverage ratio. Okay, this is investment properties only. Minimum 620 credit, same thing. No income or employment verification needed. We don't put it on the application. We don't care about it. 20% down for purchases, 75% max cash out on the refinance. You have the option of a 30-year fixed or interest-only payments, depending on you as an investor, right? These conversations that we have, if you're trying to just maximize the amount of rental income that you're going to receive, then you might want to do that interest-only option because you're going to hold that property for extended period of time. It's going to appreciate, and it's a really long buy and hold option for you. So you don't have to worry. You don't necessarily worry about paying down the principal on it because you know that appreciation is going to take its toll on this, and you're still going to make money off of it. And on top of that, you're going to maximize the amount of revenue that you get every single month, right? No prepayment penalty option available. So these do come with prepayment penalties. Okay, usually 6 months is what you're seeing, is what we see. But it depends what the client wants to choose. There are options where the client doesn't get a prepayment penalty, maybe if they're going to refinance in a year or two. But the problem with the no prepayment penalty option is that usually the rate is much, much higher. It's almost atrocious. So it may not make sense for them. Rental income needs to be at least 75% of the proposed mortgage payment. So if your mortgage is $2,000 a month, as long as you're at $1,750, I believe is the number, you should be fine in terms of that rental income. Okay. You typically already have to own a property, but there are exceptions for this. Okay. I have one company that we use that doesn't require you to actually own a property, and you can be a first-time investor. But most of the time, you do have to already have a primary residence that you live in order to utilize these. That company that does it, they're usually at about 25 to 30% down, depending. Okay. So contract to close. This is what it looks like from beginning to end. We're about 10:40, so we're gonna be wrapping up. We're gonna kind of fly through this. We're gonna go take our time on the appraisal and then fly through the rest. Okay. 5 basic steps that take place, but a lot of different people that can touch a file in any given transaction. This is the biggest reason why timelines may take longer than expected. Okay. So loan officer, once we get that contract, it's the file's still on our desk, right? And it depends how quickly the client moves, is how quickly we can move the file. Okay. If we need updated pay stubs, updated bank statements, because these people have been looking for 3, 4, 5 months, we need them as soon as possible. If we told them at pre-approval, you need to get an IDR, make sure that you get an IDR. We sent it through email. We CC the realtor. They go looking. They have short-term memory. Then they forget. Now they're under contract and I say, hey, you need an IDR. What happened? Oh, I called one time and I hung up. I need you to get the IDR situated today, right? And that may take a few days. So whatever the case is, depends on really the client at that point. And then once we get all the updated documents that we need, we'll send it over to processing. Processing usually takes about 1 to 2 days to send it into underwriting. Underwriting takes 1 to 2 days to get that loan approval. So in the perfect scenario, loan officer desk, 1 day, processor, 2 days, underwriter 2 days. We're looking at 5 days realistically for us to get that loan approval. And that's if the client gets us everything that we need within that, right? After the underwriter gives that loan approval, there's conditions on there. A lot of them are typically internal. Some of them are going to be based on the bar, right? We need to make sure that the EMD, because we have bank statements, we don't have transaction histories, right? We need to make sure that the EMD cleared their account. So now we need an updated transaction history. They may have credit inquiries. We need to get a letter of explanation, make sure they didn't take out any new credit. They may have a large deposit. What is this for? Is it a bonus? Whatever. So those conditions will be sent to the bar. And usually same thing, depends on how fast they get it to us, depends on how quickly we can send this in back into closing, right? Some of those other conditions are going to be third-party conditions. Title, right? We need to make sure title's back. We need to make sure appraisal comes back at the price point and it's not subject to, it's as is, right? These things, once we get all those conditions cleared, we send it back into the underwriter. Typically takes about a day for them to review. Then we get to closing. The biggest timelines that we see is usually the condition gathering stage, because clients drag their feet a little bit. They've already been under contract for a week and a half, 2 weeks. Things are smooth sailing. And so they may wait a few days to get us everything that we need, as opposed to start being a little bit more, I guess, moving a little bit quicker. So that's usually the biggest gap that we see from loan approval all the way to closing, is that condition gathering stage.
Mike.
Yeah.
So at the beginning of the pre-approval stage, when you meet the client and you discuss everything that they need to do, and so you would tell the client the do's and the don'ts, no large
Correct.
deposits, all these things
Correct.
before, okay.
We do that. Yeah, we do that all the time, but
They don't listen.
I mean, especially lately, I love my clients. I love my job. But for some reason lately, clients are acting like they're not listening to you, or like you've never told them these things. And I'm like, I have a pretty good memory. I'm like, I remember sitting on the phone with you. Me, not the team, me. I had this conversation with you. I remember. So I don't know what's up with them lately, with clients lately. I think it's just the market itself. But we're putting everything in writing moving forward, because yeah, they are becoming a little bit forgetful lately. I don't know why.
It's the
Um,
food.
Probably. Appraisal can come in one of two ways. Okay, as is, meaning there's nothing that needs to be done, and subject to, which means there are repairs that need to be done. The appraisal is dependent on the repairs being done. The value does not increase. This question has been asked to me before, right? Where, hey, once they get this and this done, is the appraisal going to increase? No, the appraisal is subject to these things happening in order for you to actually be able to close on your home. That's it. The price point is already set. So, yeah, let's say if it's FHA and there's termites or whatever, wood rot, that stuff would need to be fixed in order for that appraisal to be as is. If the repairs are minor, right? Minor repairs that are not too crazy, but it's stuff that the appraisal wants done. There are times where we can do what are called escrow holdbacks. Highlands does it. A lot of other lenders can do this as well. You can ask your loan officer about it, but escrow holdback is basically, let's say the window needs to be repaired, right? The bars from the window need to be removed. Some old houses have that. Whatever it is, repainting because of chip paint. You can basically say, okay, get me a quote for how much this is going to be, and we can try to escrow it at closing. And so now, instead of having the seller do it, say, hey, appraisal's not clear, two options. You do it or you give us a credit. And so now the buyer will get it done after closing. That's what's called an escrow holdback. So after they close, they are responsible for getting this done as soon as possible. Okay, because it falls on you as the realtor and it falls on us as the loan officer. We're doing this, we're trusting you, client, to make sure that this gets done. It's very, very serious. If you don't do it, the banks don't care. They'll start the foreclosure process because they can't sell this loan. So they might as well just get rid of it. Very important that they get it done. But escrow holdbacks are a thing if it's the repairs are minor. Good practice to always require seller to close any open/expired permits. Hey, Monique, yeah.
Sorry, I don't know if you mentioned it, if I missed this or not. So in the event that they decide to do the escrow holdback, which I didn't even know you can do, does the buyer have to get the appraiser to come back out again? Because typically during that process, the appraiser goes back out to verify.
Correct. So yeah, once it closes, once the buyer takes care of everything, then the appraiser will come in after closing to do the final inspection.
Okay.
Yeah.
Thank you.
No problem. Safety/structural damage is not good on any appraisal, right? Listing agents say, I don't want FHA because the roof is falling apart. And I say, conventional is not going to accept it either. I'm sorry. So there's things that not even conventional does either. The difference between FHA and conventional is more so, I would say, safety issues. The biggest thing is chip paint, termites, wood rot, and making sure the appliances work. Everything else, if there's holes in the wall because they were in the middle of a demolition, conventional, you're not going to get the appraiser to clear that. They have to repair that. Okay. FHA, make sure this is not a flip within the last 90 days. So, and a lot of listing agents, typically they know this, and you guys know this as well, but just making sure that, that the person didn't buy the property a month and a half ago, you have a FHA client and now they're trying to resell it. You can't go, it's not that you can't close till day 91. You can't go under contract, sign, execute it till day 91. Okay. Little tip, if you're about 15 days away, let's say 15, 20 days away, you do the contract, we do everything except order the FHA case number. We underwrite the loan, everything. Then on day 91, you redo an executed contract, but we've already been under contract for 15 days, getting the financing done for the client and stuff like that. So we can close a little bit quicker. But yeah, you can't go under contract till day 91 on a flip. 9 times out of 10, the appraiser is right. Okay. So now we're going to jump into this appraisal really quick that I got for you guys. This client went under contract at 445. And there was 3 comps here that the appraisal used. Appraiser used 460, 390, 370. And I looked at this and when we're doing, when we get that contract in, we depend usually on the agents, the listing agent, to make sure that they're priced correctly, the buyer's agent to make sure that they did the CMA as well, to make sure that it's going to be within that realm. So we don't look at this unless this happens. And then now I have to kind of sit down and look and see, did the appraiser do the right job? Most of the time, 9 times out of 10, they did, right? There's very, very few times where the appraiser actually messed up. And I'm able to kind of point it out and say, hey, this is incorrect, right? So on this, you can kind of see here, this is comp number 1, comp number 2, comp number 3, and you're going to see adjustments, positive and negative ones. And so his adjustments were pretty consistent throughout in terms of what he did. Okay, so the first thing is basically he gave us, when I see this, I know that the appraiser's trying, and they're trying hard, right? This is an adjustment for appreciation. So that means that basically this comp closed in January, and now we're in, I think this was April-ish, or around March, April. We're gonna give $5,000 appreciation for that, right? This one closed last year. We're giving 20,000 appreciation, right? So when I see this, I'm like, oh, all right, this guy's trying. And then he did adjustments for the lot. So a lot of appraisers don't do this because they don't really. I don't know why the lot, unless the lot is really significantly bigger, you very rarely see adjustments on lot side. On this one, he kind of washed it because it is not that much of a difference. But here, and I just saw this for the first time, but look at this, 6925. Okay, no, it's 900. Oh, I'm tripping. I thought this for that. I thought I was reading 6980. Sorry, dyslexia. Okay, so 6,080. He gave $7,000 on that, and then because this one was bigger, he minused out $2,000 from here. And then of course the square footage. Our subject property is 1364, 3-bedroom, 2-bathroom. He's using this 4-bedroom. He's helping us. He's also saying, hey, this 1,900 is about 600 square feet difference. And you're talking about basically a third bigger. Right, negative 28,500. This one's smaller, so we're going to give you some. This one's smaller, so we're going to give you some. And then these two were really upgraded. This one wasn't. These are the adjustments, and then this is the number that it comes down to. So I look at this and I say, this makes sense to me. But of course, the listing agent is, oh my God, I can't believe this. There's one that sold this one for this price point, whatever. Buyer's agent freaking out. You know, this is not going to close. What are we going to do? So I said, you know what? You want me to submit the appraisal dispute? I don't think it's going to go anywhere. Send me your comps. I want to see your comps. And so they sent me their comps. Okay. I can't email you the appraisal, Tiana. I can email you the presentation. We're going to be wrapping up soon. We might actually cut it short. I don't want to pass the 11 o'clock. She gave me these three: 459, 2301, 460, 3501. 3471, 400,000. Okay. And so I looked at them and I basically wrote this email to her and said, good morning, Janae and Silmar. These are the listing agent and the buyer's agent. We're going to submit the comps. I really didn't want to, but I have to if it's my job, right? But before I did, I broke it down. I said, you sent today, but I want to make a note on what I see and what I know the appraiser is going to say as well. The first comp you sent is more than 1.5 miles away from the subject property. It won't be the best one to use as there are closer comps to the subject property that sold recently. So we're looking at this. The appraiser used, where am I looking? Right here, 0.21 miles, 0.32 miles, 0.3 miles. If I were to send him that comp, he'd be like, Mike, what the hell are you doing? This is literally in a whole different city. The second comp actually will hurt us, not help us. So not sure if we should include it. Reason being, it sold at 400,000. It did. Well, it sold at 400,000, which is less than what they actually wanted, with 400 more square footage than the subject property. On the appraisal, he made adjustments based off of square footage. This would give us an adjustment of about 380K based on square footage. So she sent me one at 400, thinking it's going to work. And I told her, hey, our subject is much bigger. What are you doing? The third comp is the one he is using on the appraisal report and giving it the most weight so that it can help us get to the 414K price point. However, it's adjusted because it has considerably more square footage than the subject property. So she sent me a comp that was already on the appraisal, right? Which was this one here, which is the one that he really used as the one that weighed the most, even though it was much bigger and had an extra bedroom, right? So from that 445 price point, we got all the way down to 414 as is. We ended up closing it and the buyer still ended up getting a seller credit. I think it was like $5,000. And I didn't have to submit the dispute. I sent that email. An hour later, she emailed me. She said, I'm going to talk to the seller. Next day, they were moving forward at that 414. But that's why I say 9 times out of 10, appraiser is right. I do have a winning record against them because I know when to choose my battles. I know how to read an appraisal. I know how they do their adjustments. And so, yeah, this is something that when you guys get it, just kind of know, just really it's more the consistency throughout the appraisal, right? Because appraisal is just an opinion of value. That's all it is. Even if he's certified to do it, it's his opinion on what that is. So what you want to look at in the report is not, hey, is this supposed to be at this price point? Let me look at inconsistencies. Let me see if I can make sense of this, right? Why did he adjust for this, but not for this one? And this is both the same thing. I've caught that before, right? What? Like there was one time where he actually went to, it was a condo. He actually went to, I'm going to start going back to the presentation, but he actually went to the unit and he measured the unit. And the unit on the property tax website was smaller than what was set on the actual property tax site. I think it said like 1,200 square feet, and he measured 700. Okay, fine. But guess what? There's other units in there in there that you're using as your subjects. And what are you doing? You're using the full square footage that you see on the property tax website because you can't go to that and actually measure it. Correct? So when I pointed that out, he was bitching and moaning and fighting. And I made a really good point to my appraisal desk team and said, you're measuring this one, but you're not measuring the other ones. And you know that the other ones are probably going to be the same size because this is a condo. All the units are pretty much the same thing. So you're basically giving them way more value than what you're giving to this one. And we ended up getting a new appraisal, and the new appraiser went out and actually got us what we closer to the price point that we wanted. Okay, rushing through this. Employment changes. Recent student graduates gets new job as doctor, nurse, engineer, lawyers are eligible for purchase after 30 days of work. They don't have to have 2 years of being in that job. W-2 worker quits to start new business or 1099 pay, cannot do. Must have 2 years of self-employed, but the vice versa will work. Business or 1099 goes to W-2, green light. Sourcing funds, large cash deposits into bank account will never count for available funds for closing. Anti-Money Laundering Act, red flag. Very few exceptions. If you went to CarMax, they gave you, or you sold your car to someone and they gave you a check, you need to have a copy of the check, the bill of the sale, the title, switching everything over to their name. It has to, all your paperwork has to be very, very clean, which is those exceptions. Credit/rescore. If borrower's score comes back low, we can do rescore to increase within a couple of days. I do not advise borrowers, don't ever advise borrowers to pay off credit card debt without consulting us, because they're going to pay stuff off and waste money for no reason. Contract tips, always be aware of your loan commitment date and extend loan commitment date when you're extending your closing date. Okay. It's a nice little trick you can do when the listing agent agrees to an extension. Just extend that loan commitment date with it as well, because usually most of the time we're extending is because of the loan. Check off correct financing program on page 2 of the contract, and borrower has to apply for that mortgage ASAP. Okay. That's pretty much it. 1056. Perfect. You guys have any questions?
Hey, Mike, you mentioned that for, I think it was like lawyers, engineers, is that limited to those professions listed, or like
No.
it could be any other profession?
Any profession that person went to school for that.
Okay, thank
Yeah.
you.
No problem. Any other questions? We're good. I know some people had to drop off. I don't want to make these an hour long, so we're going to kind of throw these in here and there, because I want to make sure that you guys are not, stuck here to the screen. I want to be respectful of you guys' time, but I hope you guys enjoyed it. Thank you all
Mike,
for coming. Oh,
I have
yeah.
one more question, if you don't mind. I'm so sorry to interrupt.
No worries.
Okay, so earlier, this is more so personal. So in regards to conventional loans, you mentioned earlier that to get certain funds, you didn't have to be a first-time home buyer, or what's the difference between, let's say I have a home already and I want to buy another property, but I don't have the entire 20%. Is that something that I can do? Because I noticed you mentioned investment properties and then conventional loans.
Yeah, so if you're moving from one primary to the next, you only need 5% down. So if you're leaving that property and you're going to buy a new primary, you only need 5%.
Okay, gotcha. Thank you.
No problem. All right, thank you all. Thank you guys so much. Most likely I'm going to be gone. I leave tomorrow to California, my first vacation of the year. Took a while. So we may
Good
not
for
have
you.
thank you. We may not have Monday Mortgage Minute next Monday. And Tuesday is going to be 4th of July. we'll see. If I come back, I'm coming back Sunday. I'm probably gonna be working on Sunday. If I catch up, we'll have it. If not, I'll see you guys in 2 weeks, okay? Thank you all.
Thanks, Mike.
No problem.
Thanks again, Mike. Appreciate it.